Today, I'm going to be ranking all of these stocks based on their projected return profiles over the next 5 years. I'm going to run these stocks through a DCF calculator, and I will be going off of the average analyst estimates for these stocks' earnings per share and free cash flow per share growth rates for the next 5 years. Now, for some disclaimers, I will be biased in this video. For certain stocks, I may go a little bit above or a little bit below analyst estimates, as I will go with the growth rate that I believe is most realistic and are most likely for each company. So in doing so, there will be clear bias, so don't take this video too seriously, as it's just a fun little opinionated ranking. And also, some stocks may be out of certain categories by like half a percentage point. For example, if we get a return CAGR of around 19.5% in a stock, I'll put that stock in the good return category, but that stock can easily be in the moneymaker category if it was, again, like half a percent higher. So I wouldn't take the categories too seriously either, but all that aside, let's get right into the projections, starting with ASML. The average analyst estimate for ASML's earnings per share growth over the next 5 years is between 16 and a little over 18%. Now, this is one of the cases where I went a little bit higher, and I have earnings per share for my base case around 20% for ASML. And there's two reasons for that. One is ASML, their management, I wouldn't say they sandbag, but they are very conservative with their guidance and with what they say they will do in terms of revenue and earnings per share. They basically always beat what they project out. They want to make sure they are conservative enough so that they can beat the guidance that they give so that they are trustworthy to investors. Number two, I think investors are really underestimating the demand for ASML's high-NA EUV lithography machines over the next 1 to 3 years, because we're seeing companies like TSMC and other chip manufacturers saying they are going to greatly increase their capex over in 2026 and 2027. And like big tech and the Mag 7 saying they're going to greatly increase their capex, the majority of that goes to Nvidia, while for TSMC and other chip manufacturers, for their capex, the majority of that is going to ASML for their lithography machines, and more specifically their high-NA EUV lithography machines. ASML sales of these machines are going to just explode over the next 1 to 2 years. I believe they're guiding for between 30 to 35% revenue growth just for 2026, so earnings per share should be even more than that as well. And of course, after 2027, I expect growth to normalize a bit. So I do expect around a 20% earnings per share CAGR over the next 5 years for ASML. And I'm assuming slight multiple compression. They're a little bit expensive right now at a 50 PE, but I believe a 40 is fair for arguably the greatest monopoly in the world. So given these assumptions, we get a 15% return in the stock. That puts them firmly in the good return category. And next we got Celsius Holdings. The growth rates for Celsius they range greatly from 9% all the way up to 31%. We have a huge range here, so I went around in the middle at 20%. I believe 2026 and 2027 for Celsius are going to be years where they focus more on revenue growth and just getting their new brands, Alani and Rockstar, into as much shelf space as possible. Celsius, the core Celsius brand will still grow very nicely, but they're really, over the next couple years, focusing on getting, again, that more shelf space. I believe they're going to triple Alani's shelf space just this year. So right now they're just in growing that consumption and growing the revenue of the core brand. But once they go through that phase after 2027, I believe then they'll focus heavily on margin expansion from there. I believe they'll still grow in around low double-digit range, which is very good growth for a drink company. But at that point, the story is going to be margin expansion. So I believe 20% free cash flow per share growth is very doable, and I gave them a 3.5% free cash flow yield, which I believe is still higher than Monster Energy's free cash flow yield, so not that expensive at all. And in this scenario, we get a 24% CAGR. That easily puts Celsius into our moneymaker category. And next we have AMD. Now, if you watch my AMD video, you will know that I'm very bullish on AMD. Once they release the 450 series this year, then the 500 series next year, I believe those chips are very great competitors that can go toe-to-toe with Nvidia's best chips and can even outperform Nvidia's best chips in certain categories for these AI models. I don't think they'll overthrow Nvidia or anything like that, but I believe AMD will be a valid competitor and not straight up alternative, but really good for other workflows. And we're already seeing the proof of this with Meta and OpenAI doing extremely large, both 6 gigawatt plus deals with AMD. So that's already almost several $100 billion guaranteed for AMD over the next several years. And the company itself is guiding for 35% revenue growth over the next 5 years. So to assume 35% free cash flow per share growth is pretty conservative, as I could see that being 40% plus. But for a base case, we'll stay around 35. And I gave them a free cash flow yield of 3%. And that's actually decent multiple compression from where they are now at a 2% yield. However, by 2031, people are not going to be paying the premium for AMD as they are now, because they'll be at the end of their growth phase. People will then be skeptical over whether they can continue to grow at the rates that I believe they will through the end of the 2020s. So by then, I believe multiples will compress a bit, but given these assumptions, we'll still get a 20% return in the stock, which again puts them in the moneymaker category. Now we got Meta. Now Meta's a little weird with running projections on them right now. For one, with free cash flow is super depressed right now because of their insane CapEx spend. So it's a little hard to run projections on free cash flow per share, but their net income and earnings per share is also depressed because 2 quarters ago, they had a one-time tax hit that just completely destroyed their profitability for that 1 quarter. So it just makes their earnings per share look very depressed right now and artificially low. However, I believe running my projections based on earnings per share is still better than free cash flow for Meta specifically, because free cash flow is going to be way more depressed over the next several years because the spend is just going to continue. It's just going to keep increasing as well over the next several years. Not as crazy, but it will keep increasing. So their free cash flow is just going to be severely cut down over the next several years, while even with the high depreciation, net income isn't going to look as bad as free cash flow. So we'll go based off earnings per share. With Meta, analyst estimates are between 18 to 22%. One even says 15%. And I decided to go with around 19%. And if you just look at Meta face value, you see they grew 24%. So most people not looking too in depth into Meta would assume, okay, they're growing revenue 24%. So net income is probably growing 24% or even faster due to margin expansion. However, depreciation exists, and that is going to severely depress Meta's net income and earnings per share over the next several years. Even if they grow incredibly fast, like they're saying they guided for between 30 to 33% revenue growth for Q1 2026. So even if they grow into the mid-20s, even low 30s, depreciation is going to hit hard. And if that revenue growth decelerates back to 20% or lower, then their net income is really going to feel it. But I believe they could keep 20+% revenue growth for many years now, especially if they grow 30% for a while. So I believe 19% earnings per share growth is very doable for Meta over the next 5 years. And I gave them a PE multiple of 30, which I believe is very fair for a company like Meta, one of the largest companies in the world, growing incredibly quickly and a very underrated moat. So with these assumptions, we get a 20.8% return in the stock, which puts them in our moneymaker category. Next, we have Elf Beauty. The average analyst estimate for Elf is around 20%, and I agree with that. This is one of those cases where I agree with analyst estimates. I think 20 is, for a base case, makes a lot of sense for Elf over the next 5 years. And I assume a bit of multiple expansion from here, from a 4.4% yield to a 4% yield. So given these assumptions, we'll get a 22% return in the stock, leaving it at a $223 stock in 2031. Very much puts Elf in our moneymaker category. So now we have Amazon. Analyst estimates for Amazon range between 15 to even 21%. Now, I went pretty low for this one. I went 15% earnings per share growth for Amazon. Now, some of these base cases are a little more optimistic than others. This is not that case. I went a little more conservative with Amazon. Not that I'm not bullish on them. I am very bullish on Amazon. And this 15% can change to a lot higher of a percentage, solely based on where I see AWS growth go over 2026. If we see way more acceleration in AWS growth, then I believe that earnings per share could easily be 16, 17, 18+%. But for now, I want to stay a little more conservative and bake in the depreciation into their estimates. I mean, to have to depreciate $200 billion just for 2026 alone is insane. We need to see more AWS acceleration to compensate for that. But given 15% earnings per share growth and a 35 multiple, which is very fair for Amazon, we get a 19% return, which puts them at the high end of the very good return category. Next, we got a very controversial one, which is Duolingo. Now, surprisingly, the average analyst estimate for Duolingo's free cash flow per share growth is still around 24%. I'm surprised after their last quarter that's still so high. But Duolingo is a good case where your opinion on the stock and the trajectory you believe the company is going completely determines the return profile. Like the difference in return, if you're even slightly bullish on Duolingo or slightly bearish, is incredible. Because even if you're slightly bullish on Duolingo, they're such a profitable company with such a great balance sheet. They have over $1 billion in cash and no debt. And their market cap is like $4 or $5 billion. I mean, they don't have to even hit grand slams every year to be an incredibly high return stock. If they could reaccelerate user growth at all, then this is going to be a winner over the next several years from this price. However, if they can't reaccelerate user growth, then that is a huge problem, and this would be a almost value trap. If you'd like to see my full in-depth breakdown of Duolingo, I do have a individual stock analysis video on it, but just to give you my quick take here, I am overall bullish on Duolingo over the next several years, but even going a lot lower than what analyst estimates have apparently, I have 18% free cash flow per share growth for Duolingo over the next 5 years. And again, they're very cheap right now. They have an 8% free cash flow yield. So if they go down to even a 5% yield, that is huge multiple expansion while still being pretty cheap for how profitable of a company this is and how fast they are growing still. So given these assumptions, we'll still get a 28% return in the stock. And again, even after huge deceleration last quarter, they're growing free cash flow 42% on a trailing 12-month basis, and quarterly they grew at 27% year over year. Assuming that doesn't decelerate too much and they get user growth reaccelerated again, and then they reaccelerate revenue growth again. So again, like it is important that they reaccelerate user growth, but free cash flow growth at these levels is phenomenal. 27% year over year, 42% on a trailing basis. This is very high growth. They don't even need to necessarily reaccelerate free cash flow growth. However, they do need to reaccelerate user growth. That is important for the future of the company. But I have Duolingo in the moneymaker category. Again, even if you're slightly bearish on Duolingo, that can easily put them in the dead money category. So Duolingo is very much a judgment call stock. Next, we have SoFi. Average analyst estimates for SoFi range, again, a huge range, is between 20 to 42%. Huge range there. Again, I went somewhere around the middle at around 30%, which I believe is very doable, as SoFi is just in the last couple years becoming profitable, and now earnings per share is obviously exploding now as they get into more profitability and their revenue base expands a lot more as well. So 30% earnings per share growth over the next 5 years is very doable, and I believe revenue will grow around 20 to 25% over the next 5 years as well. So very fast growth, but I am assuming pretty decent multiple compression from here, from a 45 PE to a 30. I wouldn't want to be too bullish and expect too high of a PE multiple for a company like SoFi. You always want to be a bit more conservative for like banking / fintech companies more so. So even with these assumptions, we get an 18% return on the stock, which easily puts them in my very good return category. Next, we got another controversial one, Hims and Hers. Like Duolingo, another stock with a huge range of earnings per share estimates, ranging from 9% all the way to 23%. I went on the high middle end there with around 17% earnings per share growth. And I also have an individual stock analysis video on Hims as well, so I would recommend watching that to see my full in-depth take on Hims. But even though they have a lot of regulatory scrutiny on them specifically, and a lot of competition in the category. I believe HIMS will do very well over the next several years. They'll see huge revenue deceleration in the next 1 to 2 years, but I believe that'll level out and they will adapt and they will be able to profit greatly from their hair loss, skincare, ED, and other products outside of weight loss. So giving 17% EPS growth, I'd say around a 30 is fair for a company that's this profitable and at that point has a decent moat over their category, their industry. So with these assumptions, we'll get a 16% return in the stock, putting them in the very good return category. Now, before we get into Shopify, I decided to add 4 stocks. I added Texas Roadhouse, Salesforce, Tesla, and Cava. So let's actually get into Texas Roadhouse first. Texas Roadhouse has been one of the best performing restaurant companies and stocks over the past 5 years. Such a well-run company. And it says right here they grew earnings per share 24% on average over the last 5 years. For a restaurant to do that is incredible. However, law of large numbers, Texas Roadhouse is hitting right now. They're still expanding. They're still growing very nicely. However, growth is clearly decelerating and will clearly decelerate even more over the next 5 years. So assuming revenue grows still high single digits, maybe even low double digits, while having margin expansion and or share buybacks, we'll get around a 14% earnings per share growth. And I believe a 28 multiple is fair for Texas Roadhouse. You can maybe argue a little bit higher, but again, I like to be slightly conservative, especially for companies that could be more impacted by the economy or certain black swan events. So in this scenario, we'll get a 12.7% return in the stock. That puts them in line with S&P category. Now we have Salesforce. The analyst estimates for Salesforce range between 12 to 15%. I chose the high end of 15%, because they just reaccelerated revenue growth to 12+% and announced I believe it was $60 billion plus buyback. So they're buying back shares like crazy. They're at an insanely cheap PE right now, historically speaking, for Salesforce, and they just greatly increased the acceleration on their revenue growth. So I believe 15% earnings per share growth is very doable for Salesforce. And if we go to even a decent PE for the quality and moat of a company that Salesforce has and is, then we'll get a 19.5% return in the stock, putting them in the very good return category. Now we have an interesting one here. Might get some hate for this, but again, this is my opinion. This is not necessarily what's going to happen. This is just what I personally believe. So let's get into Tesla. Analyst estimates range between 24% all the way up to 68% for a 5-year earnings per share CAGR. Now, in my opinion, this is a bull case for what I have for Tesla. 25% earnings per share growth and 150 multiple. 150 PE multiple still. And we're basically flat on the stock with a 4% return. I don't believe Tesla is going to be the hottest stock, the most loved retail stock in 2031. People move on, and I believe people will find other exciting opportunities, meaning we will see huge multiple compression out of Tesla, even if they grow very nicely over the next 5 years. But again, this is my slightly bullish case. If we just look at the numbers, net income is not even steadily, heavily, quickly increasing down. Free cash flow is somewhat stabilizing, but still down a lot from highs. And again, earnings per share is also very depressed. If we look at vehicles delivered, it has been flat and even slightly downtrending over the past several years, which is their core business. Obviously, Tesla investors today are banking on Optimus and Robotaxi being huge businesses for Tesla and compensating for their EV business not doing as well in recent years. But keep in mind, Tesla is trading up to 340 PE based on businesses that they haven't even really started yet. I mean, Tesla's Robotaxi has started at this point, but it's in, I believe, just a handful of cities. I don't even know if they're out of the first city that they started in yet. They could be. I could be wrong on that. They might be in a couple cities at this point. But it is many years before it's nationwide and a meaningful business to Tesla. Same with Optimus. So even if we assume 20% earnings per share growth, and the multiple goes down all the way back to 100, we will get a negative return in Tesla. Again, this is my opinion. Maybe Tesla turns around their EV business. Maybe Tesla's Robotaxi just sweeps the nation and is just such a large business for them. And Optimus gains a lot of traction too in the late 2020s and 2030s, but I think that is the ultra bullish scenario, not the most likely scenario in my opinion. So I have Tesla in between the dead money and will likely be a loss categories. In my opinion, I believe Tesla will likely be in one of the have a return profile like that over the next 5 years. Again, could be wrong, but we will have to wait and see. Next, we have Shopify. Something very interesting about Shopify is if you look at their 5-year revenue CAGR, they grew 31% over the past 5 years. Their revenue went from 2.93 billion to 11.56 billion over this 5-year period. But if we look at what their stock price has done, in that same period, the stock price is down 2% in the past 5 years for Shopify. Obviously, if you bought them in the 2022 dip, you would have made so much money. They went, I believe, even below $20. So obviously they were extremely overvalued back then, and there were time periods when you could have bought the stock and made a lot of money. But just based on a 5-year time frame from now to 5 years ago, the return is not good. It has been dead money. But the past does not determine the future. So let's look at where Shopify is going over the next 5 years. Analyst estimates are between 21 to 25% for free cash flow per share growth for Shopify. So I went on this kind of high end of that with 25% free cash flow per share growth, and I gave them a yield of 2%, which is still very expensive, but I believe that's a fair yield and is still decent multiple compression from here. So given these assumptions, we'll get a 14.5% return in the stock. So that puts them in the very good return category. And now we have Apple. Apple's earnings per share estimates range between 9% all the way to around 15%. And I went on the high end of estimates because Apple is actually reaccelerating revenue growth very nicely. They do such an immense amount of buybacks, and they're not spending on CapEx like the other Mag 7 companies are. So they're not going to have insane depreciation over the next several years like the other CapEx spenders are. Now, whether that hurts them long term, that remains to be seen. But over the next 5 years, it will be a direct benefit to Apple as they won't have that CapEx just weighing down on in terms of depreciation on their net income. So I have earnings per share of 15%, and I feel like a 30 multiple is fair for Apple. They could trade up to 35, but again, a little more conservative. I went to 30. So given these estimates, we'll get a 12.5% return in the stock, which puts it in line with the S&P around 8 to 13%. And now we have Google. Estimates for them range between 12 to 15%, and I went on the high end at 15% because again, depreciation is going to hurt them very hard. However, Google Cloud's revenue growth acceleration is so insane. Last quarter, it grew 48% year over year. And I believe this is only going to continue to accelerate even more from here over the next year. I believe next quarter it's going to be 50+% revenue growth for Google Cloud. So I'm very bullish on Google Cloud over the next several years. I'm bullish on YouTube. I'm even bullish on their core business, Google Search. And of course, there's the incredible opportunity with Waymo. So even with great depreciation costs, I expect earnings per share to at least grow 15%. And I expect revenue growth for the whole company as well to continue to accelerate. And I believe a 28 PE is very fair. So in this scenario, we get a 13% CAGR in Google. That puts them in line with S&P category. And I could easily see them get into the very good return category, even with slight multiple expansion. But I'll play it a little conservative, and I believe it's slightly more likely they'll be in line with the S&P. So now Microsoft. Estimates range between 13% all the way up to 18%. I went around in the middle at 16%. I am not someone who believes that AI is just going to completely disrupt all of Microsoft's their whole software suite. I don't believe that. However, it is possible we do see seat dilution. I believe that's a fair argument to make for SaaS companies. However, Microsoft is already cross-selling AI features and products, and that is accelerating their revenue growth. And I believe that will continue to accelerate their revenue growth and will more than make up for any possible seat dilution that we may have. Again, we don't have seat dilution yet. Microsoft right now is making more money off of AI features and products that they're selling to their customers. However, they are not losing any money on seat dilution. They could, I'm not discounting that fear, but that is also something that we are not seeing yet while we are seeing them benefit from AI. So I believe 16% earnings per share growth is very doable for Microsoft, and I believe a 30 PE is very fair. So given these assumptions, we get a 17% return in the stock, which puts them in my very good return category. And now we have Mastercard. Estimates range between 15 to even 19% for Mastercard's free cash flow per share. I went on the slightly conservative end at 16%, even though I'm very bullish on Mastercard. I believe they can easily do more than 16%, but even with a 16% free cash flow per share growth and a 3% free cash flow yield, which is still pretty high historically for Mastercard and for the moat that they have, you still get a 20% return in the stock based on, in my opinion, conservative estimates. So Mastercard goes into my moneymaker category. Now Adobe. Estimates range between 10 to 15% earnings per share growth for Adobe. I believe 13% is very likely for Adobe. I believe they'll continue to grow revenue high single digits. They could even, if they re-accelerate revenue growth because of cross-selling AI features to their customers like Microsoft is doing and other SaaS companies, then 13% may be very low. But assuming high single-digit revenue growth CAGR over the next 5 years, and also doing the immense amount of share buybacks that they're doing. I mean, look at this shares outstanding chart. They reduced their share count by 6% year over year. And that's only accelerating. I believe they could take out 6 to 8% of their shares outstanding just this year. So 13% earnings per share growth and a very low PE for a company with such an underrated moat. A 23 PE is not, that's slightly above a market multiple. And we're talking about an incredibly high moat, incredibly profitable SaaS company being Adobe. A 23 is not expensive. So given these estimates, we get a 22% return in the stock. That puts them into the moneymaker category. And next we have Nvidia. Nvidia is an interesting one because growth, I mean, it's absolutely phenomenal right now. I believe they grew 70+% year over year last quarter. So it's just insane. Their guidance was insane as well. And the estimates range between 23 to even 40% CAGR over the next 5 years. Again, their growth over the next 1 to 2 years is going to really pull up their CAGR over the next 5 years, because I believe after 2027, growth is going to decelerate greatly. In my opinion, I think the numbers between 50 to 70% of all of Nvidia's revenue comes from the Mag 7. And the Mag 7, they physically cannot increase CapEx at the rates they've been doing. I do believe they will continue to increase it over the next several years, but they can't just up it 50%, 70%. They can't do that. Amazon's not going to go and spend $300 billion next year on CapEx. So it's only natural that Nvidia's growth rates are going to insanely decelerate. Now, I don't know what it'll decelerate to. Will it go to 20%, 15%, 10%, even lower? I'm not sure. So I went around the midpoint of analyst estimates at 30%, and I believe a 28 is very fair for this company, as by the point of 2031, same case I made with AMD, we will see multiple compression at that point, as people will be less sure of growth rates by then. So with these assumptions, we get a 22% return in Nvidia. So they go to the moneymaker category. And next we have Cheesecake Factory. I have free cash flow per share growth for Cheesecake around 12%. I believe Cake's revenue growth will accelerate to the high single digits, possibly low double digits over the next several years, as Flower Child and North Italia, two restaurant chains that they started and own under the Cheesecake Factory company, I believe those will continue to grow very well over the next several years and be more meaningful towards Cake's overall growth, especially Flower Child. That brand is growing over 30% year over year, so that's definitely just a huge hit. So with revenue growth acceleration and share buybacks as well, I believe 12% free cash flow per share growth is very doable for Cake. And assuming a decent amount of multiple expansion as they accelerate revenue growth from a 5% to a 4% free cash flow yield. Given these assumptions, we'll get a 16.8% return in the stock, which puts them in the very good return category. And now we have Nike. Another one that's a little hard to run projections on, as they are in turnaround mode right now. And like Duolingo, this is very much a stock that's based on your personal belief and conviction in it. If you're slightly bearish, Nike's not going to do well over the next 5 years. But if you're slightly bullish, then the turnaround will work and they will go back to very healthy net income and EPS growth and revenue growth over the next 5 years. And analyst estimates range between 12 to even 21% EPS growth. So I went around 17%. And historically speaking, I believe a 30 multiple is very fair. So given these assumptions, we'll get a 13% return in the stock, putting them in line with S&P category. Now, ServiceNow. The average analyst estimates for ServiceNow is between 21 to even up to 28%. ServiceNow is just one of those companies you can expect to reliably grow 20+% revenue growth year after year after year. So as their revenue continues to compounding, I expect to see decent margin expansion as well. So 22% free cash flow per share growth is pretty fair, even conservative in my opinion. And assuming decent margin expansion to 3.5%, which is so much lower than their historical yield. However, I'm not expecting ServiceNow to go back to their highest yield that they used to have. However, I do believe they have oversold and will go to a more fair yield around 3 to 3.5%. So with these assumptions, we get a 25% return, leaving the stock price around $337 in 2031. So that puts them in the moneymaker category. And now we have Uber. I'm someone that believes Uber will successfully position themselves to be the AV platform app. They are the app that connects the AV providers with the customers. They have the customer base and they have the data. Most AV providers can't just get that customer base that Uber has and will likely lose a lot of money trying to do so. So Uber will continue to expand internationally and domestically as well in terms of their core business, and Uber Eats as well. But I believe they'll also get a lot more AV deals. So both are great growth paths for the company. So I went around 18% free cash flow per share growth for Uber, and they're trading very cheap right now at around a 6% yield. So even decent multiple expansion at a 5% yield will get around a 23% return in the stock, putting them in the moneymaker category. Now we have Zeta. If you're unaware, Zeta is an AI marketing company. And not to go too in depth, they have proprietary data that is some of the best data that you could have in the world on hundreds of millions of individuals. And this data allows them to market for companies so specifically, and it gets them a return on ad spend of around 6 to 1, which is higher than even Adobe and Salesforce's return on ad spend. So this is a company with an incredible product that will only be accelerated by AI and are expected to grow just rapidly over the next several years. Free cash flow CAGR ranging from 24 to even 32%. And I believe that could even be higher to 35, even 40%. But I played it a little more conservative with 30% free cash flow per share growth and around a 4% yield. And in this scenario, we get a 30% CAGR, going from a $17 stock to a $64 stock in 2031. So that well puts them into the moneymaker category. Now finally, we have Cava. This one might make some retail investors a little upset as well. Here's the thing with Cava. They're expected to grow very nicely over the next 5 years. 20+% earnings per share growth expected, which is very, very good for a restaurant company. However, I believe they are so overvalued at this point with a trailing PE of 140. Their free cash flow yield, I believe, is like 0.5%, maybe 1%. I don't believe just the best case scenario is baked into this company. I believe unrealistic expectations have been baked into the stock price. If the company grows earnings per share 23% and we still give them a high multiple of 70, you only get a 6% return in the stock. So this company would just have to blow away everyone's expectations to be a good investment. And of course that's possible, but I don't believe that's the most realistic scenario. Unfortunately, I'm gonna have to put Cava in the dead money category. But I'm gonna end this video here. Here is my final ranking. And again, certain stocks can go to higher categories. Like I could easily see Google, Apple in the very good return category. I could easily see, ASML, Amazon. I could easily see the whole very good category being a moneymaker stock. But based on I gave a slightly conservative view to all of these companies on my base case scenario. So again, obviously very biased, but this is what I believe these companies' return profiles will roughly look like over the next 5 years. So I thank you all for watching, and I will see you in the next video.